Hello, I'm Nathan Kubik, and thank you for joining us for the Karnik and Kubik third quarter of 2017 Capital Markets Outlook. Today, we'll be discussing what we're observing in the financial markets, as well as what we recognize as the most noteworthy influencing factors. After a discussion on potential impacts of those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. This quarter, we observed many of the same themes we've presented over the previous 2 quarters. However, there has been a shift in the attributes being rewarded by the markets. We will discuss why this shift is meaningful and why we view it as appropriate. We will discuss some of these attributes throughout the presentation in more detail. Additionally, we will focus on areas that we identify as risks and areas that we recognize as opportunities. The discussion over and under valuation will once more be front and center as we discuss economics, world dynamics, style and sector weightings, as well as the current interest rate environment. Despite a plethora of large news items that would be expected to adversely affect the financial markets, investor confidence has continued to rise as the markets have shrugged off international tensions, failed healthcare reform, and the impacts from recent hurricanes. This is in part explained by economic indicators as a whole continuing their positive trend, but also explained by the strengthening fundamentals for domestic companies. Economic growth has continued to drive forward at the same modest pace of just over 2%, while inflation and interest rates have remained at historically low levels. Valuations for most asset classes remain above historically normative levels, but as we will discuss, given the current market conditions, it is arguable that these valuations could actually be warranted. One example of market impacting events is that of tax reform. While tax reform is far from being figured out in any definitive way, the markets are clearly pricing in the likelihood of it succeeding. As outlined in this chart, almost every income level is expected to receive a tax break or no change on their personal tax bracket. At this point, most of the specifics remain unknown. However, it is likely that most personal exemptions would be eliminated under the plan, with the exception of the mortgage interest rate deduction and the charitable deduction. That said, the standard deduction amounts are likely to be increased. I should note that the lowest tax bracket is increasing from 10% to 12%, but the increased standard deduction is expected to more than offset that difference. The big concern related to tax reform is that of balancing the budget. A couple of weeks ago, the Senate agreed on a draft budget that would provide for $1.5 trillion in tax cuts over the next 10 years, or in other words, an average of $150 billion in annual reduced revenue. Ignoring the fact that we are already running at a $700 billion deficit in 2017, and that we're talking about increasing that another $150 billion, there are still very large hurdles to overcome before tax reform can become a reality. As outlined in the chart, all of the proposed tax cuts amount to a total reduction of the federal budget by $5.3 trillion over the next decade. New sources of revenue only amount to $2.8 trillion, leaving a gap of $2.5 trillion. Assuming that the $1.5 trillion draft budget is indeed a reality, this still leaves us with $1 trillion of required additional revenue or reduced government spending yet to be determined. On the next slide, we'll take a look at where that gap needs to be addressed. Looking at the chart on the left, we see the total spending from the federal budget and where those cuts could potentially come from. If cutting those costs are not a viable option, new tax revenues will have to be identified. The bottom line here is that there is still a long way to go before the tax cuts that are being proposed will be in alignment with our country's income, spending, and what the long-term impact on our deficit will be. It is certainly possible and even likely that we will see tax reform. However, we are still in early stages in its development. The equity markets have continued to move upward with growth-oriented companies capitalizing more effectively than that of value-oriented companies. Given the current interest rate environment and the fact that all asset classes could be considered fully valued, companies that are able to grow their top line and bottom line earnings at a greater rate are being rewarded, and rightfully so. Over the past quarter, we have further focused our attention on underlying company attributes, financials, and indicators likely to result in greater growth rates, and with the financial strength able to justify current valuations and continued performance in years to come. Breaking the previous slide down by quarters, we can see that this has been a steady trend for all of 2017, and longer if we remember that the fourth quarter of 2016 was heavily influenced by financial and energy sectors, impacted primarily by expectations from the election outcome. Given the current valuation levels, low inflation, and low interest rate environment, we expect this trend to continue. I will, however, note that we expect greater disparity in performance for companies within each of these styles. We believe that the stronger fundamentals, capital deployment strategies, and earning trends are playing increasingly important roles from an individual security standpoint, and we have positioned to that end. Price to earnings valuation metrics have shifted a bit upwards as well. It is interesting to see that the large value valuation metric moved up by 1.6%, where the large growth metric only moved up by 0.6%. Taking that piece of information, along with the fact that large growth outperformed large value by 2.4%, you might ask, how do we reconcile those items? How is it that large growth stocks priced increased that much more dramatically, but the valuation metrics moved up only fractionally compared to that of value stocks? The answer is earnings. Large growth companies have been successful in increasing earnings at a much faster rate than that of large value companies, and as a result, the change in valuation metrics did not need to adjust much. In short, the takeaway here is that while growth companies outperformed by a meaningful amount, it was the value companies that became more overvalued based on historical averages. In this slide, we will dissect where the total returns of the S&P are derived from. The light blue area represents total returns generated from dividends paid. The green area represents the impact on total return from increased company earnings. The gray area represents increased valuation multiples. As we can see in recent quarters, companies have effectively been able to grow their earnings, which resulted in stock appreciation. Further, the markets clearly believe that these companies will be successful in continuing to do so in the future. As a result, the companies have been awarded a higher multiple as a result of that expectation. Should the markets be correct and earnings continue to grow, these historically higher valuations will have been proven to have been warranted. Valuation metrics will return to historically normative levels as earnings will have caught up to today's valuations. This is all yet to be seen, but indicators in recent performance do seem to indicate that we are headed in this direction. Technology and healthcare stocks have continued to lead in performance in the year to date. Financials had a strong showing in the third quarter, while consumer staples and consumer discretionaries have shown some softening as of late. Materials and industrials also had a good third quarter, but we believe part of that is due to the shorter-term expectations on increased needs as a result of the hurricanes. With the exception of consumer staples, every other sector moved higher during this past quarter. Here we look at the weights of the S&P 500 sectors, and that of our core equity model. The sector returns at the bottom of the chart are highlighted in efforts to depict where we are overweight in green, market weight in yellow, and underweight in red. At the top, you will see our actual current target weights. Our largest overweight has been and continues to be the technology sector. It is one of only two sectors that we see to be undervalued based on earnings, and still appears to have the most potential from both a fundamental and technical standpoint. Healthcare is the other sector that appears to be undervalued. Last quarter we mentioned that we believed the healthcare sector to have turned a quarter and was moving back into favor. This appears to be further substantiated by what we have seen over the past quarter's performance and from other market reaction indicators. We added a bit more to the overweight of healthcare this past quarter. Technology, healthcare, and financials are our three overweights going into the fourth quarter. For our core equity model, energy, telecom, utilities, and real estate remain slightly underweighted in relation to that of the S&P 500. Here, We take a look at the tactical weights of our dividend equity model compared to that of the S&P 500, as well as our own internal long-term strategic target weights. Because this equity model is focused on increased stability within the equity markets, it does look at investment criteria through a slightly different lens than that of our core equity model. With slightly different goals in mind, it weights certain characteristics differently than that of our core equity model. And to that end, when we created the dividend model at the investment committee level, we decided on a long-term sector target weight, which can be seen above. When comparing these weights to that of the S&P 500, you can see that some of the heavily growth-oriented sector target weights were reduced, and some of the more defensive sector target weights were increased. Given the importance of strong fundamental companies in today's markets, there is currently a good amount of overlap between the dividend model and our core equity model. Additionally, you will notice that quite similar sector over and underweights are present when comparing the two models, simply with a slightly altered baseline. For all of our equity strategies, we believe that we have entered a time period in which individual security selection and active management should be rewarded to a greater degree than it has in years past. Recently, historically high levels of correlations between stocks and the S&P 500 have declined dramatically, which makes sense. As stock valuations increase, correlations tend to increase, and most stocks benefit from the rising tide of investor confidence. Eventually, the markets reach valuations that investors begin to take notice of the growth and fundamentals required to justify those valuations. At some point, like where we are today, market reactions begin to more dramatically reward or penalize individual companies' actual underlying performance and changes in their financials. When this occurs, individual security selection, risk analysis, and market expectations become increasingly important. It is also critical to identify companies that are best positioned for future growth, but are also somewhat guarded against the risk of performance missteps. As a result, we look for companies with more inelastic demand for their services and products, but also the ability to grow and benefit from the continued economic environment. With the supply of fixed income securities remaining relatively constant, increased demand and fund flows from domestic and foreign investors have held interest rates to historically low levels. As depicted in the graph on the right, private foreign investors have been pouring money into our fixed income markets. Due to the lack of yield alternatives, bond prices have continued to rise and yield spreads have continued to tighten across all income-producing securities. The graph on the left depicts the difference between the treasury rates and that of other investment-grade bonds. As you can see, the difference has gotten smaller, which puts us in a more interest rate sensitive environment. This also makes a case for being patient and very selective in the current markets. The interest rate environment does remain relatively similar to where we ended last quarter, with the exception of the treasury curve flattening a bit further. International demand for our fixed income products remains high, with foreign interest rates remaining quite low. With the expectation of the Fed funds rate to be raised again, the short end of the curve has moved up as depicted in the chart. However, the long end of the curve has not moved in kind. This is a difficult time in the bond markets and is a critical time period to be patient and not to take undue interest rate risk exposure for virtually no upside. With the exception of defensively structured preferred stocks, corporate bonds, and municipal bonds, there are virtually no income-producing securities that we would find to be overly attractive. Because of this, the prudent course of action appears to be quite clear, and we are confident in the positioning of our fixed income portfolios comprised of appropriate structures, credits, and durations. In conclusion, while we do feel like some areas in the markets are overvalued from a historical perspective, we do feel good about where we are economically and where we believe we are headed. We believe that we have entered a time period where we will see greater disparity in performance among individual securities. And while style and sector allocation is always a critical component, we also believe that individual security selection has the opportunity to be rewarded to a greater degree than it has in past years. There is much that will unfold over this next quarter related to taxes and international tensions, and we are monitoring all of these issues very closely. We are continuing to position your portfolios in efforts to reduce downside risk exposures while maximizing your risk-adjusted returns. As always, thank you for placing your trust in us. Please reach out to us if we can provide you with any additional information or clarity on anything that has been presented. Take care, and we look forward to speaking with you soon.